Hey, greetings and welcome to my Thursday edition of Macro to Micro Power Hour. I'm Samantha Leduc, founder of LeducTrading.com, and very excited to be joined by Cem Karsan today. We're going to get
Karsan,
that
yeah,
Carson. I like the croissant. It's like croissant.
exactly.
We're going to get into lots and lots of due diligence here on market structure and what's happening with the markets right now. But first, I want to do a little housekeeping, and that is that I'm very excited to say that this macro to micro power hour, which I hold twice a week, Tuesdays and also on Thursdays, right after the market close at 4 o'clock, is now available to download on all your favorite podcast platforms, including Spotify and Apple and Audible. So just search for me, Samantha Leduc, or your favorite guest. Again, Leduc Trading is also my YouTube channel, and when this is done, it will be housed here. Leduc Trading YouTube channel, and underneath I have a macro to micro power hour playlist. Further down, you've got some trading insights if you're interested. I also feature a Women in Trading and Finance series, very, very supportive of attracting and inspiring, supporting women in trading and analysis. So definitely check that out. Jem and myself can be found on Twitter. I have but a humble following, and you are just unbelievably popular, including your own Discord channel that you didn't even know about, which is hysterical. A client brought that to my attention, and I went, "That is so cool." So yeah. Let me just unshare here for a second, and I'll do some intros. So, first of all, thank you so much for joining. I am very interested to also find out what's going on with your business of late. You have rebranded, it sounds like, your fund. So, tell me a little bit about this fund, and then we'll kind of get into talk about the market.
Yeah, we're launching two new products July 1st for Q3. One of them is focused on the second order Greek kind of dealer positioning flows that we've been talking a lot about for the last year that have kind of given me a bit of notoriety. We have been traditionally a vol arb shop and have used those flows in the background of our vol arb strategies. We're drawing our distributions when we're looking at valuing, relative value on these vol arb trades. Those distributions have become a huge amount of the attribution of the returns of the strategies, and we decided several months ago to spin them out into their own strategy. So really a directional market and vol trading strategy, which is quite different than our kind of delta neutral vol arb strategies, which are traditional. So as we make that transition, we really want to make sure that we face the world with kind of this, we've become thought leaders in this flow trading dynamic, and really want to position the firm in that direction. So the new name of the firm is Kai Volatility Advisors, and we're launching a new educational portal, as well as a lot of kind of exciting content to come, for all of the followers and people who are interested in learning more about kind of how we approach markets. So hope to
All
talk
right.
about some of that today, but that's kind of why we're heading in that direction with the new brand and whatnot as well.
And who's your key audience? Well, who do you want to really pay attention to? Because obviously you are on a public feed for Twitter and providing a lot of educational support, which is hugely helpful, and hence why you have this, secret Discord fan club channel. But who is really a good candidate customer for your fund?
So, we love, first of all, the whole world is looking for diversification away from long market exposure, right? Obviously the 60-40 world risk parity is dead for obvious reasons. In a liquidity bubble like this, which we are very much in, everything's correlated to one on the downside. So there are few people who truly understand how to diversify away with derivatives and other volatility products. We obviously, over 13% of the volume in the S&P 500 when I had my market making firm. We understand these intimately, have been in this business for 24 years. So it's a natural fit for us to kind of step into that role. And we're trying to offer more and more products for everybody, honestly, to help teach them and educate them about what is available to diversify away and to create not only a hedge to their broad long portfolios, but also yield generating and profitable strategies that take advantage of these flows and the supply and demand dynamics that exist in these markets. So to answer your question, everyone, I think this is our minimums are 250,000. So we're looking for high net worth family offices as well as institutions primarily. But the education is out there to help teach everybody, and hopefully everybody gets there to a point where they're all accredited and we can work together to help everybody.
Awesome. I wanted to hear that because this helps. You have an audience here, some very sophisticated, obviously gurus doing their own thing, and really like your market timing calls, and a lot of retail that's learning about it, right? Mm-hmm. So this is just no longer the tail, the flea on the tail of the dog. This is really wagging the dog, this optionality and the market Absolutely. Structure of this flow, which you really do well in creating a story. You, by the way, would be a really, I'm thinking writer. This has got to be a side hobby of yours or a future career, because you are creative and you have created a cast of characters and storylines and chapter after chapter. It's good stuff.
Yeah, so I said this in one of the pods I did in the last 6 months, but not everybody knows. So in undergrad, I actually studied financial mathematics. That was my primary focus.
Okay.
I did policy as well. So I was always into kind of macro policy. That's kind of why I wax kind of about policy a lot of times and its effects. But also a triple major was an English lit major. That was something that I did in my free time and ended up becoming a major. So, English lit
I'm a daughter of an English teacher and professor.
So,
yes.
Yes. I appreciate you noticing. Yeah, no, I do enjoy that part of it, and it makes it more fun. Obviously, if you're talking about this stuff every day, you want to make it entertaining for not just your audience, but for yourself as well. So
Absolutely.
Half of that's for my own benefit.
All right. Keeps you interested.
It does.
All right. So now I'm interested, and I'm sure audience as well, some of your volatility trading strategies. I know you've talked about your legacy stuff. For sure, the long vol, historically, and you've done really well historically, but I'm more interested in your market timing calls of late. It seems like there's been a real transition into timing kind of the micro moves.
Yeah, that's a big part of, so our strategies, as I was saying before, take advantage of not just relative value on the volatility surfaces and between different products. So we don't just have this relative value model. We also look at, in static, we look at the distribution of market moves and are predictive in our selection process as well. And those models, those distributions for both market move and volatility move, given market move, have evolved over time, and they more and more over the last 5 years have begun to include more reflexive dealer positioning flows. And as part of that, obviously the distributions have become more and more predictive and more an attribution of the profits that we realize. And so that part we have gotten better at, and you obviously are using it more and more, and hence the launching of a new product to focus on that. So. Yes. So happy to kind of discuss those flows. Those are very much micro. Our distributions are done on a weekly basis, so they are very tactical, short-term, supply and demand driven. I think we've talked about this before too at other places, but looking at things dogmatically over kind of longer terms is a hard thing to do when you're looking at supply and demand, but you can be very predictive of short-term flows if you understand the genesis of them and where they're coming from.
So define short-term, because everyone has a different definition. I mean, I've got a chase, a swing, a trend time frame, but
Sure.
That is very different in everyone's book. So what define a short time frame?
Yeah, our framework is broadly monthly, but our distributions are weekly. But we look at predictive metrics that are multi-annual, as well as intraday. So we have lots of different factors. We have 27 factors in our distribution model. And again, they range from a lot of them, more than 50% are flows based, but there are some in there that are much more macro fundamental. There are some that are technical, more traditional stuff like momentum and mean reversion within the model as well. So,
And you do all this in kind of like a data visualization, so you're looking for particular signals or actual patterns. I mean, how are you actually
yeah,
kind of manifesting?
each factor is developed differently, has different transformations, we've used machine learning on the back end. Obviously, most of our analysis is qualitative and comes from experience, but the implementation and the optimization is done very quantitatively. And we in terms of visualization, we do have a visualization of each factor and a metric for each factor, but then how they relate to the whole model is also,
This is
ultimately
all your secret sauce. You're not
yeah,
sharing. Okay, so
yeah. There's
now
only so much I can tell you, but
That's all right.
I think
That's
I've
all
told you a
right.
lot, right?
That's okay.
Yeah.
But now let's get into, because I many understand, some don't, but definitely convexity and risk premia. Convexity is to risk premia as reflexivity is to deal positioning. How do you position and anticipate those actors, because they seem to be a very heavily weighted component of your market timing calls?
Yeah. So, the idea of reflexivity obviously is, if there's a large part of the street that is positioned in a certain way, and there is a profitable trade, relative value, very risk reward, positive positioning based on how these where the flows have been and push things to. Ultimately, in order to profit from that positioning, people have to take a profit. They have to unwind that position. And unwinding that position doesn't mean unwinding it strike by strike or position by position. It means unwinding the factor exposure tied to that. And so, that factor exposure, broadly in the volatility space, tends to be exposure to skew, exposure to term structure, exposure to vol in general, as well as market direction and delta. So, those factors based on this positioning, and you can deduct based on that, flows coming in to take that exposure off as that exposure changes, and that reflexivity, right? That need for, it's just like if somebody is short on a more simplistic, short stock, if short interest is very high in a stock, ultimately to capture that profit, they're going to have to buy back, right, the stock. And that reflexivity there, as we've seen in stocks like GME and other meme stocks, right, has a real predictive value to it. So similar, much more detailed, much more complicated
Do you go into
reflexivity.
a smaller time frame, like yesterday with the SPX? It hit a volatility trigger of 4170 and went down to 4130. There was already kind of that negative gamma, and then reflexively it bounced very strongly once it hit that level. Are you doing that? I mean, intraday, are you doing that type of scalping or chasing, or do you pull back a little bit more in time and kind of work with a wider aura?
Yeah, so
Volatility.
we're trading a lot of different. So we're trading correlation on a directional basis, dispersion on directional basis, as well as on a vol basis, right? We also even do those trades on a on skew. So we do kind of dispersion, skew, et cetera. So things get a little wonky and more detailed. That said, I mean, vol itself is one of those major components. And so when we hit support levels, and our models are reading more positive, we do look at levels a lot. Like I put up my own levels as well, where the supply kind of is at its highest level. Those are levels to kind of jump in and increase positioning, whether it's in vol or directionally in the markets as well, given these Vana, Charm, Volga, Voma flows, which are essentially going to give you a sense of where the strong directional component is. There are also
Get
windows
tired
of
of
time, which I think is important. So it's not just the positioning, it's not just the levels, right? I think a huge part of the analysis that we do really functions on timing as well. So there are windows of periods when the flows are going to be greater, when they accelerate. These are non-linear kind of factors, and there's based on positioning on expirations, there's also understanding of timing when things are going to increase or decrease. So.
And risk premia, you had a really good market timing call into the election. It was bid up, and just that reduction, if you will, in the risk premia gave that boost to the market direction. And you had seen that, I'm pretty sure, in advance. Is that correct? That was
absolutely, yeah.
Yeah,
We talked about that months. We talked
Yeah.
about that months leading up to it, but
Yeah.
yeah,
So
absolutely.
have you seen? What do you see now?
Yeah, so we're in a much less, implied volatility has come down dramatically, right? We're in a part of the market where, despite there being oversupply of vol, there's less Vana thrust, right? But there's more stability. So I think that should get more, a reduction in implied volatility going forward. So it's going to be the most challenging thing for this market is fighting the oversupply of vol right now. So that paired with the fact that broadly there's a lot of bearish sentiment still, a lot of skepticism about this rally, that should reflexively lead to kind of a continued rally in this market. But unlike the election or something like that, it's not going to be driven by as much a Vana effect as it will be by more of a charm and steady kind of consistent passage of time and decay of risk premium. My view is that will, obviously structurally on a more macro level, as rates continue to go higher and as you get this, for lack of a better term, tapering, of the, again, not necessarily just by the Fed, but broadly the long end of the curve, naturally kind of yields going higher, the liquidity will continue to diminish. And that has a breaking point for this market, and structurally on a much bigger level, there are major issues for this market that lie ahead. So,
talk about the Fed reaction function, because I think that's where this is going.
Yeah. I'd love to talk about the macro part. I mean, obviously at the end of the day, that's the most important part, right? But that part can take not just months, but years to play out sometimes. And so I think people get too dogmatic about that and try and play it on a short-term basis. I think the key is to have that view and to understand that it's coming, but to also play kind of week by week based on supply and demand dynamics, prepared for when that reflexivity kind of unwinds. So that's our broad approach in terms of the macro perspective part. Obviously, this is a liquidity-driven bubble. I did a podcast that just came out this week with Corey Hofstein's Flirting with Models. I think that gives people a bit of a, if they want to go listen, it'll give them a lot of insight into how we see kind of this playing out. But ultimately, as long-term rates go up, the liquidity available in the market declines. A lot of the malinvestment leads to, this is a tale as old as time, right? That malinvestment has to come off the table. You get creative destruction, et cetera. That liquidity removal will create multiple contraction. That will create more, less money available to corporations and high net worth individuals to buy stock, right? For companies to buy their own stock. Those things are ultimately bad for multiples. However, the reaction function has changed, right? It used to be that the Fed would come in, decrease interest rates, and don't fight the Fed. Ultimately, I think the difference here this time is, for the first time in 40 years, we are seeing a massive fiscal push. The zeitgeist has broadly changed. People are actually, they're optimizing. The government's optimizing median income as opposed to mean or maximizing GDP. Optimizing for median incomes and the demand and votes, from the electorate for that type of policy will push price inflation, not asset inflation anymore. And we've had massive asset inflation for 40 years on the back of supply side economics. I think demand side economics is what's happening now, and should continue. People are gonna, you're already seeing positive reactions to all of the fiscal stimulus that we've had. It's hard to imagine that in 2010 Republicans were fiscal conservatives. There is no fiscal conservatives anymore. It is left and right are both populist, and I expect that to continue for a decade. If that does, long-term interest rates will go higher. The Fed will not be able to control it. If they try and do yield curve control ultimately, which is, they can push the curve down on this just based on supply and demand, but ultimately that's massively inflationary because, with reals, getting more and more positive, you're ultimately going to create more and more inflation. And the Fed knows that. They know it ultimately puts the Fed in a box. And so they will lose control the long end of the curve.
That is a very well understood concern, which then helps me segue randomly and yet not so much. Bitcoin. What are your thoughts on?
You're trying to get macro me,
is dead. No, macro is dead, and I'm not even a convert. I'm simply saying that migration, because of everything that you just eloquently laid forth, is driving so much of the crypto craze, and some of it rightfully so. Others, like I said, this is a debasement concern that you wouldn't want to wish on your worst enemy. But the point is, you have laid out the macro. Now talk to Bitcoin and crypto.
Yeah, you're gonna get me some hate mail.
I am, but we got to do it because it is a huge asset class. It's growing every day, right? We have to address it.
Sure.
Because it is now a macro
Happy to talk about it. But I want to preface this by saying I do not manage Bitcoin in my funds. It is not systemic to what I do. And so I have my opinions just like everybody else. I'm happy to talk about them. But please don't send me your hate mail.
Okay, now that you've done that disclaimer.
Yeah. So
and by the way, I treat it like a commodity and trade it as such.
Yeah, and absolutely, you can trade it as such, and just again, we trade supply and demand flows, and there's obviously those are very prevalent in Bitcoin as well, but it's not something we trade. My view is that liquidity bubble, at that like we're in, assets, story stocks, do very well. And there's, this is not a fundamentally driven market. It's a function of supply and demand. And right now there's a supply and demand imbalance in Bitcoin and cryptocurrency. The amount of people trying to get exposure to it and the growth of that sector relative to the supply is imbalanced. And that's why it's going exponentially higher and has continued to. That said, like I said, with my macro view, I think we're at the tail of what's been a very long kind of run for liquidity based kind of meme assets, and I view Bitcoin and cryptocurrencies as a liquidity driven bubble. My reason
coach you on that.
Not blockchain. I want to be very clear. Like I think we will move to a digital dollar. I do think over time. I do think blockchain technology will be pervasive and is a secular story. But I do believe cryptocurrencies and the sheer mass of the number of them, the overwhelming majority will be eventually worthless, and they are not the beneficiaries of blockchain necessarily in terms of asset values. My view of that is and I could be wrong, but my view of that is based on every currency since the beginning of time, if we're talking about it as a currency, has had some source of power to support it and ultimately benefit from it. And the powerful of the world, have always used currency as a form of benefiting their and that's the argument for Bitcoin, right? But ultimately, it's funny. I said this on Twitter before. Everybody always makes the argument: don't fight the Fed, don't fight the Treasury. Why is that? Because they're bigger than the market, right? They're the biggest. Don't fight the bully, right? Don't go challenge them. But the thesis behind Bitcoin is essentially or DeFi is essentially the exact opposite. It's fight the Fed, fight the Treasury, fight the powers that be, and that's all fine and well, and that's all great to go scream "Viva la Revolución," But practically speaking, if you're going to sit there and challenge the Fed and use that as your primary kind of investment thesis,
Yeah,
you're generally going to lose. So it's not in the best interest of the US government or the developed world to allow a currency that they cannot control. So they will exert control over it. There are already lots of conversations happening in the current administration about bringing it in and auditing it and making sure that it's better controlled. And the more they do that, the less DeFi, or less, DeFi is probably the wrong term, the less freedom as a currency it has, and the less appeal it has. So again, my view is based on that. I think it's there's a lot of dream, a lot of this fits a lot what a lot of people want to feel. It will give them freedom, but ultimately it is not in the best interest of the developed world and the powers that be to allow it to be as free as it currently is.
How about just as a commodity to use as a hedge for inflation, as a means for entering and moving fast and furiously into this?
It's a story.
It's a story. Lots of storied stocks, though, are in meteoric rise.
Agreed.
This is still a interesting.
This is not a short-term call. This is not a short-term call.
But my question is, do you look at this rotation into this particular asset class in your model? Because it's garnering an enormous amount of attention and funds, obviously. So do you look at it as part of your model?
Currently, no, it's not part of our model. We do have a. I'll take that back. It is a pool. It is in a pool of assets that represent liquidity assets, and we look at it as such. So to the extent there is liquidity assets and lack of demand there, that speaks to broader flows. But it is on its own not a single indicator for our models.
And it's very hard for you to measure risk premia in Bitcoin, where you can do so well in measuring it in equities and the indices. So right now, you had just mentioned, obviously, climbing the wall of worry, for lack of a better term, higher. What would be a trigger for lower that you would take seriously? In other words, what fund flow reversal would actually have you sit up and take notice and say, yeah, we're not going higher. There's an avalanche, or whatever. Just
yeah. I want to be clear, and I talk about this on Twitter a lot, but for your audience, we very much look at things in distributional form. These are not like, hey, we're calling for higher, not lower, right? The distribution is right, justified, right? Like there's a high expected and narrower than it has been, but the tail is fat. Fragility in this system is very high. Liquidity on the tails is almost non-existent. There's too much leverage built up in the system, and whereas you have oversupply of support and resistance, given oversupply of vol, locally, the second you move away from that, the amount of leverage does not support. There's not enough support for stocks, and given kind of valuation metrics and that lack of liquidity, there will be a break as rates go higher, as commodities go higher, and so the question is, within a range, you want to be continue, especially during windows of positive flows. You want to be riding the wave higher, but you always want to have, like to say, cheap convexity in the portfolio, funded with local volatility. So local volatility is, in my view, overvalued, right? As long as the tail is, you have extra convexity available to you in the tail. So it's really about positioning, making sure you own the right part of the distribution for when the break happens, and that you ultimately own the tails, but locally are short implied volatility and vega. So I don't know if that makes sense to your average listener, and I'm happy to kind of expound on that a little bit. I know it's complicated for some, but it really is a function of we're not saying up down. We're saying up, high probability with lower volatility on the rallies, particularly locally, But if it breaks technically and the demand flows are, there's not enough demand flows, that once it does break, you should expect a big move. And you need to structure your portfolio to benefit from.
Do you think the recent dispersion trade, if you will, of the indices grinding higher, sideways to higher, and the high growth, but no or low earnings, no dividend, in some cases, no revenue type of stocks that have had such a fall from grace in the past little bit? I'm thinking ARK and related funds and their top 10 and biotech, and I could go on. The
Sure.
EV plays, the just from pot stocks to anything that was SPAC related. All right, so we have a tremendous momentum is down and value is up, and it's a wide dispersion. Do you see at any point this rotation pulling down the indices, because it's really it's very evident that the dispersion trade, or if the divergence alone, one is going to catch up, one's going to catch down, but each leg of the table keeps kind of weakening and falling short.
Yeah, I mean, look, we've called for this. We called for this rotation in last July. It's
all of a sudden valuations matter.
Yeah, nobody. We were way ahead of this, obviously, as part of the election call as well, and the move to fiscal. We still strongly believe that this is a secular trend. This is it's been almost a year since it. Well, I guess about 9 months since it started. We feel like this is a decade-long trend. This decade-long trend is that doesn't go in a straight line, to be clear. So I think a lot of your but it's gone so far. I mean, this is a 40-year cycle, and it's tied to interest rates.
It's also tied to things over paper. That was my theme last summer for clients, because I was very excited about this as well. It's time, multi-decade lows in commodities and real cash flow and assets that can be liquidated. It just was a time for this kind of get up off the bottom and real economy type of transition. So it's interesting. I'm just wondering if I didn't realize that you had that same type of transition, that call, if you will, but I do.
Yeah. Simply, no, that spot on. I think
from paper to things.
Yeah, correct. So the key is that a lot of people have been calling for that for 20 years, right? And I think the important part here is our approach of our flows-based approach. So things can be fundamentally out of whack for a long time, and it doesn't change until the flows change. And the point here is what changed starting in July, August was the understanding that the flows were about to change on a macro level. And I think that's the part that a lot of people are missing. The flows, the pipes coming out of, from the very top have changed. It was for 40 years, supply side, all going to the rich, the wealthy, the corporations, interest rates, supply side economics, right? And what's happened is the demand, the kind of people, and it was accelerated by COVID, right? Was this understanding of inequality and enough is enough type zeitgeist, right? Whether you agree with it or not, that's where we are. And politicians are, and the government is broadly trying to soothe that effect. It started with Trump, who didn't start with him, but he was more of a symptom of it, right? Coming in and being a populist president from the right, and so he's essentially espousing left ideals on an economic front, whether socially or whatever, we can put those aside. But from an economic perspective, the right move to the left, and that's just based on a demand and a change in the zeitgeist and a desire to fix inequality. And so now that we've now spent $6 trillion and there's another $2 trillion on the way, likely with infrastructure or thereabouts. People are doing well. Balance sheets are improved. The economy is showing that demand impulse, which it hasn't seen in a while. You are going to see significant economic growth, and the consequences of that is price inflation. We have not had strong economic growth for some time. People tend to think about economic growth being correlated with market valuations. They are to a point, but for the most part, given this liquidity bubble, what's more important than economic growth is the availability of capital and the liquidity for markets. And what's happening here is, as economic economic growth comes to the front, you are removing that liquidity with higher interest rates. So that has finally triggered this beginning of this rotation. And my view is once that breaks, it's not a 1 year, 9 month issue. It is a decade long correction of the imbalances that we've been seeing for a long time.
After multi-decade lows.
Correct. There's a 40-year cycle. That it started with Reagan in the early 80s, the supply side economic, which was on the back of the 70s and the decade-long 68 to 78, really rebalancing. And during that period, most people don't know, was you had very strong economic growth in real terms, but obviously awful real performance in equity markets because of inflation. And so it didn't happen overnight. It was gradual, and then got much worse towards the end. But that led the way for the 40-year supply side economic push and rally market. So I think we're in a similar situation now. It's never exactly the same, but I do see that as being kind of where we are on a structural macro level. And,
all right.
Yeah, sorry.
No, I was just say I was only, this was really pushed on Tuesday. I had an interview with Jonathan Gibbons, founder of VigTech, and he's my partner in crime on Tuesdays when we do this, talking about this inflationary impulse. Obviously, so much liquidity with so few goods to chase, basically, and there has to be a retooling, literally. Yep. U.S. shores as well as skills and on, and wage growth and economic growth being fueled by fiscal. But ultimately, this value rotation, which I have been very excited about, is something that almost seems hyperinflationary right now. He brought up the words, and I was like, no, that's a future worry. But when I look at the meteoric rise, of course, of things that had been typically not what you'd call hot fire flames, lumber and corn and wheat, and the things that physical things on top of just about all the commodities, separate from the Bitcoin and the crypto, it is almost reminiscent of when we did get into this spike higher in the early 70s. So any concerns or any thoughts on this kind of temperance in inflation, hyperinflation, thoughts on that?
No, I mean, a couple reasons. This won't happen overnight. We're not Zimbabwe. We're not Weimar Germany. There are ultimately deflationary effects of and there will continue to be as particularly as you remove some of the liquidity bubble away. So the free market system has internal rebalancing that goes on. Particularly higher interest rates will, like I said, will lead to kind of liquidation of some malinvestment along the way. There will be continued deflationary forces that feed back from the capital markets. So that will be a push-pull, right? So the higher rates go, the more problems kind of growth sectors and equities that are dependent on leverage we'll see. So that force will be a constant kind of push-pull that will not, we'll see to it that rates don't go to infinity at the, very quickly. And so, the Federal Reserve, remember, is not just, we've forgotten this over time, but is not just in charge of making sure that that employment is maximized, right? They also have the opposite side of that reflexive kind of reaction function, which is to control rates. And so they will not let rates get out of control. And ultimately, they are the ones to watch. So the economy may take a hit if they have to let interest rates go a little bit higher. And ultimately that will be a bit deflationary and will counteract the rise in rates. So this doesn't generally happen overnight. And especially in a developed world, big economy like the US, we have the reserve currency at the end of the day. And, if in order to get hyperinflation, you ultimately need some liquidation of currency. And I don't expect that to be the case here in the US. So that's my view. I think it's, yes, can commodities continue to fire higher for a while? Yes. But ultimately, if it gets too hot, too quick, the, rates will go higher, will cause market issues, which will have a feedback deflationary loop. And so this is going to be a kind of push-pull. If you look at the market in the late 1960s to early 1970s, you had a lot lot of periods where the market declined, rates kind of pulled back, right? You know, a little bit, the market stabilized, and, you know, then you kind of repeated this process over the course of a decade. That's what you should expect. Markets and over the course of a decade in real terms will do very poorly. But you know, rates will continue to go higher, and eventually, you know, all of the debt will be monetized. Essentially, that's the process we're going through this decade. It'll be a monetization of debt, and we'll grow out of a lot of the earnings problems over the course of a decade as well, and eventually lay the grounds for another boom on a decade from now or shorter. So that's the broad view. Again, I don't see hyperinflation happening anytime in the near future, but these are structural kind of trends that have been kicked off. And once they start going in one direction, you don't want to be, you better hop on the turns. Otherwise, first of all, there's a lot of money to be made, but the impact and the potential losses on potentially being on the other side of this is very powerful. So.
Then let's talk about that money. Leverage. It is obviously, in some cases, obscene, assumed obscene, very hard to actually measure. Or do you? How much is too much leverage in this lovely market of ours that is, yes, exactly. Seriously, because that is obviously, you know, canary in the coal mine. It didn't seem to upset the market when Archegos went under and hurt many of its constituents. But how much is too much? How do you measure it? When do you know it's going to hit? Like the avalanche, which really doesn't need so much of a temperature change. It's very slowly then all at once.
Yeah, that's right. Yeah, look, it's ultimately all tied into kind of volatility and positioning in the market. The oversupply of liquidity by rates leads to higher leverage, but it also leads to more liquidity, right? So what ultimately happens once you hit an inflection point is that the leverage still is too high, but the liquidity is being removed, right? If that makes sense. So if you have liquidity in the markets and you have higher levels of leverage, that liquidity will balance the leverage. When that leverage stays at where it is and the liquidity starts to diminish, then you have a recipe for disaster. And I think that's the important kind of salient point. So how much is too much? When the liquidity, particularly on the tails, starts to, when the market starts to move, reflexively, the leverage is too high, and there's just not going to be enough liquidity. So hard to say when that is. It's not based on a certain interest rate level. It's based on, kind of where leverage is as a ratio probably to the amount of liquidity, and that's heading in a bad direction. That said, it will have to, it's one of those things where when you break, 10%, it's not going to be, or 7, 8, 10%, it's not going to be a 10% move. It's probably going to be a 20, 25% move, and at which point, you have bigger problems. So
yes. The machines are much faster.
Yeah.
So talk to us about risk parity.
It's dead. I don't have much more to say.
Risk parity is dead. Long live risk parity. You know it's going to come back and bite you.
Yeah. So I think there is something interesting here to say about this. Actually, is everything in a liquidity bubble is correlated to one, as I mentioned. People are realizing this. This has entered the broad understanding, especially after 2 financial crises in the last 20 some years, major ones. I think people broadly understand the need to hedge. So you're seeing a massive influx, and people understand that you can only do that in certain markets. So you're seeing a world where people are piling into volatility products, and there's enough supply where people are, but they're all hedging in the same places. And I think this reflexively will continue to have effects. Like I said, it'll continue to let this rally go on further than we could ever possibly imagine, right? That's kind of what always forces these things. But B, when the fall does happen, it's going to be hard reflexively to it's likely to be, in my opinion, more stair steps than it is a March type event. I mean, historically, if you look at everybody's always playing the last crisis, right? That's just psychology. If you look at recent history, August of 2015, we had a huge volatility event.
The won devaluation.
The won devaluation, but relative to the size of the move of the market, it was more of a vol event, right? And implied volatilities and hedges worked incredibly well during that period, given the size of the move.
Yeah.
Everybody then piled into volatility products, saying, well, I need to be hedged. And, especially with yields blowing out in early 2016, with oil kind of dropping below 20,
Yep.
you had a bigger move in the market, but it was awful to be long implied volatility or hedges because the world was hedged. And ultimately, you had some of the most liquidation of long vol on a decline you've ever seen as a metric. Like there was a correlation break between vol and markets in that period. We see that again, and when we get to, so at that point, everybody's like, why do I own vol for a hedge, right? And you got more and more selling, and you get through 16 and 17, which is some of the most lowest implied vols in history, and never paid to be long vol. Everybody was short vol again because they had lost sight of August 2015, and you get, Jan Feb 2018 XIV blowout. And so big vol event, everybody's like, oh, I got to be hedged, I got to be long vol.
Wasn't there a really big whale also kind of holding up the market in 17? I mean,
yes, so there's that whole, the catalyst funds, not just the catalyst funds, but there were all kinds of other, there's Harvest Capital selling iron condors. But yeah, that's a whole other thing which I get into.
Yes. But that was a pinning of effect. But yes, go on.
But so early 18, you have a big vol event again, which is again just talking almost 2 years after the last kind of vol event, which was enough time for people to forget. Had the big thing. Everybody's like, oh, we got to hedge, got to be long vol again. And then you had an even bigger decline again in late November 2018, the taper tantrum, right? Which ultimately people own vol. Market decline much bigger than in earlier that year, but it was stair steps and vol didn't really play, right? Again, this is reflexivity. People were hedged, etc. Fast forward, right? A year and a half, right? And just enough time for people to forget and people to be like, okay, I don't need to be long vol. You get March of this year, right? Which is a very big vol, very fast, very painful for anybody short vol. Now the world is in that, hey, better be long vol all the time. You got to hedge with vol, be long vol. And, the next decline, which is coming soon, in my opinion, and, by September, October, will be, in my opinion, stair steps and will be marked by continued vol oversupply into the drop. That doesn't mean the rally, that doesn't mean the drop. Stair steps meaning that the market will decline on consistently directionally with a relatively low implied volatility and speed. So the hedges will be very hard to capitalize based on relative to beta. So I think that's what's likely to happen here in the next move.
So hedges will be hard pressed to pay.
Yeah. So if you're a long stock and long out of the money puts, for example, in a August 15, Feb 18, March 2020 type scenario, you will crush it on the convexity that you own, right? Okay. Because implied volatilities will rise, skew will rise, et cetera. But in a Feb 16, March, so November, December, or whatever, 2018, and again, I believe in the next coming drop, that won't be the case. You'll likely watch your out of the money puts decay away. If you go through them, you'll do great, right? If they're just directional on the deltas alone, you'll do great. But if you're trying to take advantage,
August into September of last year, where volatility rose with the Nasdaq, and when Nasdaq actually dropped 14%. Volatility hedges did not pay.
Correct. So the key is not to not hedge with volatility products, but to make sure that you're employing people who understand those dynamics and make sure they're taking advantage of the underperformance of Vega as opposed to actually deltas in the market. So
why do you think it's going to take until September for there to be?
I don't know that it'll take till September. To be clear, I'm just saying that the next move, to my first point, I think people are expecting a move. So broadly, it takes time, and people. This market is likely to grind higher, like I was saying at the top of the show, in the short term, just because there are too many people that are bearish, and there's too much oversupply of vol, and so
if people are bearish is a sentiment call, but oversupply of vol is
more than sentiment.
Flow. Okay,
it's more than sentiment, because if people are that way, they are positioned. hedged for it, and reflexively that leads to higher prices. But my point is, it's coming. It's soon. It's this year. There will be another correction. A reasonable one coming. But I expect it to come from higher prices, and not be imminent. That said, there is fragility in the system, and so when you do break technically, like, you need to be hedged, and you need to be prepared for it. So it's a tricky. You can't sit here and say market's going down, X date. You got to read the market on a short term, on a weekly and monthly basis, and be hedged, tactically, as we do during moments of weakness when flows are open to it. Understanding that you're also, the distributions are fat tail, and you need to own that, that convexity. And then you need to prepare for when it does begin, also that people are broadly hedged, and that there's a likelihood for it to be hard to monetize those out of the money. So you need to start to, as it begins to happen, to manage portfolio accordingly. So it's complicated. These things are not easy. If anybody could do it, there'd be it wouldn't be so profitable. So, but you need to kind of look at this, and always in three dimensions. Look at the time component, look at supply and demand, and understand it as a distribution of potential outcomes. So this is the world I live in.
Well, it's exciting. It's also intellectually rigorous, because you're approaching it obviously from the macro and dispersion, what I call intermarket anyway analysis. I know you do a lot of tech and quant and sentiment by studying the flows.
Yep.
But I am curious the timing of your drop in September, and the secular call for rotation is stronger than most. Stronger. I personally, I like to think of it as cyclical now. It'll prove itself later, but it's definitely outperforming, meaning value or anti-momentum over momentum or growth plays by a nautical mile. So that has been an exciting kind of rotation. And we'll see, obviously, what happens with these grinding markets. But I actually think we're going to have some volatility very, very soon. So just did my little PSA on Twitter going,
Yeah.
all right, you haven't heard from me in a while. Okay, I've been waiting for a few weeks. I've been talking about it. It's coming. It's coming. I think it's going to happen now. But this is the reflexivity of it, I think, is going to not be so intraday, but give it a few weeks, give it a few weeks, give it a few weeks. And then, yes, I think we'll.
Yeah, I think until about May 17th to 19th, it's going to be hard. We'll see tomorrow with non-farm payrolls. Again, watch rates. If you do get a technical break, which a 1 standard deviation of the 20-day is kind of is what we're watching now. If you get a break of those levels, which are not far away, given how narrow the distribution is.
Yep.
So I think you have a very tight stop there. Until then, I think the trend is higher. Don't fight, and their natural flows. These Von and Charm flows will generally take the market higher if it cannot break. So don't fight the trend. Buy the dips. Own the
If they
reflex.
cannot break.
Yeah, no. To some people that sounds duplicitous, right? Like, I want to be clear. Like,
No,
it's not. You have to look at this market where you are long and buying the dips and riding the flow higher, but own an out of the money hedge to take advantage of that reflex.
My point that
break when it
that
happens.
particular call is absolutely the 68% of the time, right? It's the edges where it might be a little bit more eventful in those events that it breaks.
Yep.
Anything that you look for, because obviously they're asking about kind of market structures for when you anticipate the breaks, or do you wait technically for the break and then to see how the market reacts?
Yeah, there's a lot of different flows. So, again, we had 27 factors in the model. So, I don't want to sit here and say there's one thing or another, but, if I want to give you a couple of clues out there, watch the weakness in the NASDAQ and tech, particularly, that's where it's going to start. It's where, that's the thing that's giving kind of the little blinking yellow, over your shoulder. There's reason for concern there. Watch the window of when these natural flows are out there. I talk about them all the time. Right now is actually a very supportive time for these Vana and Charm flows, and it will be until the 19th or so of this month.
Big stop expiration.
Yeah, so you have to kind of exactly. So you got to kind of be careful in this window and not be too bearish, right? But be aware that, if you start to see liquidation and it's going to start not in the S&P, it's going to start in the NASDAQ in particular, and names that are interest rate sensitive. Watch rates, if yields spike, like, that's a problem. That's where it's going to start. It's not, it's not, everybody knows that, but have some hedges there, right? That's another option, is not only in the names, like the ARC names that we've said to be hedged in, hold your hedges in rate slam. And so those are things that, some clues to kind of watch, but other than that, really, keep an eye on, very short-term wise, watch put call ratios and retail sentiment. Right now, people are pretty bearish, and we can continue to work higher as long as they are. If people get overextended into a rally, if we start to overstretch kind of the 2 standard deviation and sentiment's really bullish, and the NASDAQ starts to be weak and you start to break, like, those are the types of scenarios that can unwind very quickly. So those are the types of things to watch: short-term, mid-term, long-term. I think there's a lot out there to kind of watch, but those are things I look at.
Well, I thank you for explaining the kind of pricing, mispricing, and the flows that are part of your model, but also part of your sharing on Twitter that you do very generously. Also, your time doing these podcasts. It's very different flavor. I mean, obviously, this is very relaxed, right? This is like market close. Oh, it's nice to meet you, Cem. I'm so excited we're going to talk about this stuff, because you do more than just the quant analysis of what, trading range is going to be profitable from a short duration. You're also looking at major inflection, rotation trends. And I think with the macro backdrop, that's my macro to micro whole theme, right? It's like it makes the weather. At the same time, we're trading on a very different time frame and attention span. So a lot of folks here are asking very technical questions. We're not going to get into that right now. I wanted to get your time, and it's almost 5, to kind of get this broad range approach of your new fund and your very fascinating, view, and then the way that you express that, again, storybook telling. I thank you for that. It makes it interesting, and at the same time, we have to really think about what. Okay, Gary does what again? And Vanna, by the way, he's got a cheat sheet on this Discord channel that a client sent me that you have. So I love it. I'm like, he's got a fan club he doesn't even know about. Yeah. So congratulations on that. Hope you don't feel stalked. A lot of people are.
No, it's great. It's great. Life is short. I actually genuinely enjoy kind of, being able to help and make a difference on all these different people's lives, and really educating. It's something I've always enjoyed, and so that's a big driver for why we do. We're, like I said, we're going to be in the next several months releasing a new portal, free for followers and people who want to learn more, both taking kind of previous content and chopping it up and really kind of shaping it so people can more easily learn and access kind of information that we share. We'll probably start having a much more kind of structured kind of newsletter and whatnot, again, available to everyone, but also kind of to help bring people in and to understand kind of our worldview, and hopefully get more and more people to kind of work with together, both on the investment side as well as the advisory side.
Oh, well, thank you for sharing that. Where do they go to kind of track you besides Twitter?
That again, this portal will be up and running in the next couple of months. It's something that we have a team now kind of working on all this, and so I think that's a place to look. We're most active on Twitter right now, but
well, it's all good stuff, and I'm really grateful again for the thoughts, insights, timing calls, and just the camaraderie on FinTwit. It's been fabulous. I mean,
absolutely love your stuff. Thanks for having me.
Oh, it's a pleasure. And again, this will be podcast on Apple, Spotify, Audible. It'll also be on my Leduc Trading YouTube channel, so you can dissect this a little bit more. Follow Cem on Twitter, myself as well. Check out leductrading.com. I'm very grateful for your time this afternoon, everyone. And I wish you all a great evening. Happy Friday tomorrow in advance. Happy trading. Bye.
Take care. Bye.